Good afternoon, everyone. I'm Dave Casper, U.S. CEO at BMO Financial Group, and welcome to today's event. We all feel a bit of a shift in the economic environment. Record high inflation, increased labor costs, continued fight for talent, and the Fed and the Bank of Canada repeatedly raising rates, trying to prevent a recession. What we're also seeing is a stellar job growth and great stock market performance in 1 month, off the next. Pretty volatile, I would say, at the least. And the real question is, are we heading towards a recession? That's the question today. Every industry is different. Every business is different. We have businesses representing all across both countries today. Understanding the economic context will be very important for everyone. And to that end, we have 3 of our experts today to give us that context. I'm really excited to introduce, for the first time in a BMO event, one of our newest colleagues, Scott Anderson, who's based in our San Francisco office, the Chief Economist at Bank of the West, and he joined BMO's economic team after our acquisition of Bank of the West, which happened February 1st. And we have 2 of our mainstays on the call today as well. Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Earl's going to explain what the Fed and the Bank of Canada are doing to get us out of the inflation spiral and his perspective on if he thinks they will be successful. And the world famous and my great friend, Brian Belski, Chief Investment Strategist at BMO Capital Markets. Brian will talk to us about how the markets are performing despite some of these economic headwinds. Scott, let's get started right away with you. Again, welcome to BMO. Help us understand, Scott, some of the macroeconomic conditions that we're working through right now and what you expect in the near term.
Well, first, thank you, David, for that warm welcome and for joining me to BMO today. It's so great to at least virtually meet so many of my new BMO colleagues today. For those that aren't familiar with my background, I've been a professional macroeconomic forecaster now for nearly 30 years. And I forecasted successfully through the Great Recession, through the dot-com bubble. I'd say 25 years that time has been as a bank macro forecaster. But forecasting through this pandemic, to be quite honest with everybody on this call, it's been one of the most challenging of my career, maybe for economists all over the country, including at the Federal Reserve. We saw, just to give you a sense of where we've been over the past 2.5 years, we saw Great Depression levels of job loss in 2020. Over 2 months, the U.S. economy lost 22 million jobs. The unemployment rate peaked at 14.7%. It looked very, very dire. Then, of course, the U.S. government came in with close to $5 trillion in total of fiscal COVID support. The Federal Reserve more than doubled their balance sheet from $4 trillion to $9 trillion with all kinds of credit facilities that came in. So here we are, fast forwarding 2 years later, we're witnessing one of the fastest inflation rates in the U.S. in more than 40 years. One of the tightest labor markets in my lifetime. You have to go back 54 years to see a labor market tighter than it is today. So I think where we're at today is the U.S. economy is really, and the Canadian economy for that matter, is in unfamiliar twilight of an economic and financial boom that is being rapidly cooled by both the Federal Reserve and the Bank of Canada. So we're seeing very restrictive monetary policy. And while we're not yet in recession, we've had some very welcome rebound in a lot of the economic indicators, both in the US and Canada in January. The risk of recession, I still think, is very high for the US economy, at least in 2023. I put the probability at around 60%. So it's not a sure thing. It's not a slam dunk. I put about 50% probability that it's going to be a mild recession by historical standards. We're looking at something like a 0.8% decline in GDP, peak to trough, and maybe a loss of 1 million jobs, with an unemployment rate in the U.S. moving up from about 3.4% up to a peak in the first quarter of 2024 of about 4.8%. But we're not there yet. And, it looked pretty bad in the fourth quarter of last year. We really ended on a weak note in the U.S. economy. We actually had a decline in real consumer spending in both November and December. So that consumer growth engine that we've seen throughout the pandemic really seemed to stall out, and it looked like a recession might be imminent, even starting as soon as the first quarter this year. But the strong January data have definitely pushed back recession forecasts, including us. We thought we'd have a mild contraction in GDP in first quarter. Now it looks like it won't really start to contract till the second quarter at the earliest, and it might even be the third quarter. The real surprise here is just the resilience and strength, and one, the tight labor market, as Dave alluded to, and continue to see stellar job growth numbers. In January, 517,000 jobs created. We've got 11 million open positions in the United States. Initial jobless claims, at least in the early part of February, still look near historically low levels. Consumer spending jumped in January. A lot of that was due, I would be a little careful in reading too much into that January jump of the consumer. We did have that 8.7% increase in the cost of living adjustment to Social Security. So we saw a really huge jump in real disposable incomes in January. It actually grew at an 18% pace. And of course, a lot of that income growth was spent in January, and it was up 14.5%. We saw a nice jump in light vehicle sales, for example. A couple other things I think that played into the strong January numbers. We have seasonal adjustment, possible issues because of the mild winter. We saw both for January, both in the U.S. and in Canada. And as Dave alluded to, we had a real strong stock market performance in January. So we saw loosening financial conditions. Interest rates were falling. Mortgage rates dropped from 7.3% for the 30-year fixed rate mortgage in November down to around 3.6 at the end of January. So we even saw some better news on the housing market front. And the NHB Housing Market Index jumped 7 points to its highest level since September. So a lot of mixed signals there, a real strong bounce that will probably allow GDP to be positive in the first quarter. Why I don't think it's going to last? Well, one, I think sticky services inflation. Inflation itself is quite sticky right now, and it's still higher than the Fed or the Bank of Canada would like to see. So we expect continued rate hikes from the Fed, at least over the next several meetings. My own forecast, we've got 3/4 point rate hikes in March, May, and June. We think quantitative tightening is going to continue all this year, shrinking the Fed's balance sheet by a tune of $95 billion a month. And this one-time income gain that we saw in January isn't going to be repeated. The final point I'd make is just on the credit side. We do think monetary tightening is starting to bite some of the real economy. Where we see that showing up is a little bit on the bank side. If you look at the Fed's latest senior loan officer survey data, banks are tightening credit now across the board in almost all their loan portfolios. And we're seeing loan demand weaken too. And even in the multifamily sector space and even in credit cards that had been really, really strong late last year are starting to show some signs of weakness too. So there are some more traditional measures we look at. They look at the conference boards, leading economic indicators. It's been headed in one direction down over the past 10 months since really the Fed started hiking interest rates. It's been down negative in 11 of the past 13 months. And it's in recession territory. So that tends to suggest a recession in the next 3 to 6 months. We've also got a highly inverted yield curve. If you look at the 10-year, 3-month Treasury spread, it's highly negative. That's been a good financial market indicator of recession, usually turning negative on average about 11 months before a recession starts, and that inverted in November. So the timing of this recession is not set in stone. There is a chance we get off with a fairly soft landing, but I think most of the indicators still point to a recession ahead. The final thing I'd mention is maybe the housing market side, where we're definitely in a housing recession. We've had 6 months now of negative home price growth. Housing starts, sales are down, 30-40% in most markets. We've never had a housing recession. We haven't ended up eventually in a U.S. recession. So I guess I'd sum up on the recession call. with a fairly mild recession, maybe a 2-quarter recession starting in the second quarter. Looking at peak to trough decline of minus 0.8% and an unemployment rate peak of around 4.8. So it's not a great recession call. It's not anything like we've seen in past recessions. We're going from a boom to maybe a bust because of the tightening of monetary policy. I did want to say a couple of things before we move on, a little bit on the inflation front. We have seen some positive developments on inflation. I'll mention a couple of them here. But January's inflation data was disappointing, both on the consumer side and on the producer side. First, the good news. We are seeing container prices dropping, supply chain pressures are easing. If you look at the Fed's Global Supply Chain Index, it's not back to normal, but it's gone from a tightening of 4 standard deviations to maybe 1 standard deviation. We've seen energy prices dropping. Retail gas prices are still down about 33% from the peak. Container prices from China to the west coast of the U.S., Long Beach, LA, are down about 94% from the peak in 2021. And we're still seeing really early commodity price declines. Some big broad commodity price indexes are down about 23% from the peak. And just over the past month, we've seen continued declines in lumber prices, aluminum, copper, and even oil. So we're still seeing those pressures easing. But it's going to be a slog, and it's not going to be a one-direction thing. And one thing we've noticed now from the January data is the service sector inflation remains quite hot in January. We're still running at about 8% on overall services inflation. Housing inflation, we are seeing rents starting to come down, but housing inflation is still going up, and in the rent component of CPI continues to go up and is still rising at about a 10% pace on an annual basis. So it's easing, but it's too early for the Fed to declare victory here. I do think inflation is going to be lower at the end of the year than it was at the start of this year. We think CPI inflation in the U.S. will be closer to 3.3% at the end of the year. Core PCE, which is the Fed's preferred measure of inflation, subtracting out food and energy, maybe around 3.6 from a start of around 4.8. So we're in a much better position a year from now, but it won't be until really the end of 2024 before the Fed will be approaching their 2% medium-term target on prices. So in a nutshell, Dave, is kind of how we see things here in San Francisco.
Hey, Scott, thank you. Very, very thorough and very helpful. Let me, it's a couple things. I note that we have our speakers are everywhere. You're in San Francisco. I think Brian's in New York. We have Toronto, and I'm in Chicago. Your comment about rents. I don't know that they're going down in New York. I was there recently, and they're going the other direction. San Francisco, they probably are going down, I assume. That's not my question. That's just my question really is back to labor. You talked about labor, our clients. Our sense is our clients over the last couple of months have taken the foot off the gas a little bit, the sense of urgency to make sure that they get every hire in they can before the next kid quits. That seems to be lessened. I just really looking at what you're predicting unemployment going up to close to 5. Were you in the high 4s? Is that where you were?
4.8, yeah.
4.8.
About a year from now, yeah.
And how many years out? And
about a year, I think.
Okay.
So I do think we'll see some net job loss this year, but the timing is somewhat uncertain because of this lingering strength that we're seeing. As you know, we still have 11 million open positions in the United States. Jobless claims at this point aren't showing a lot of layoffs occurring outside of a few here in the Bay Area and Silicon Valley. It's been really a drop in the bucket. And, we're seeing some weakening in financial services, hiring, and a few other places, but it's still broad-based job growth. So, yeah, I mean, this is sort of an unfamiliar territory here, going from this boom situation. It's just, I think if they don't get the loosening of the labor market the Fed is looking for, they're going to have to push even harder, Dave. And that's the thing, is that the Fed, the more resilience we see in inflation, the more resilience we see in the labor market, the more the FOMC median is going to go up and expect to hike rates even further. And that's, I think.
Well, we'll be watching it carefully. So thanks, Scott. So we've seen the Fed and the Bank of Canada trying to get this under control, as you just talked. I'm going to hand it over to Earl. I think Earl is in Toronto today to talk about some of the monetary policy changes and have him give us his view as to whether it's enough. So Earl, over to you.
Good afternoon, everyone, and thank you, Dave. I do have to say, I've been in fixed income markets since 1994, and it's the first time I've been described as a mainstay as a presenter. So the five minutes of fixed income fame from 2022, some would say infamy, has extended out to 2 years now. But nonetheless, let's talk about monetary policy and bonds, 10-year bonds. They're testing 4% today, which is a big number in the U.S. But starting with the monetary policy, it's interesting. I look at 2023 as a year of easy hikes, so to speak, trying to catch up with inflation. We saw the big numbers. The Fed had to get more restrictive. 2024 now is the year of hard hikes. And the reason why it's the year of hard hikes is twofold. One is the Fed has to take into account the lagged impact of the hikes of last year. Typically, it takes 18 months for those to flow through the market. So we haven't seen the full impact. But yet, on the other hand, we have the resiliency of both the economy and inflation. And these are things that the Fed is trying to balance in regards to what to do next, how much to hike. And let me walk through why they're hiking. When the Fed hikes, and Central and Bank of Canada, what it does, it reduces growth because the funding costs for businesses are higher. So you have less businesses because you have a higher hurdle. You have less businesses, what that results in is less employment. Less employment reduces inflation two ways. One is there's less people employed, so there's less total income. Every dollar earned is a dollar possibly spent, so that's demand. And as well as it reduces the need to increase wages, that 5% or 4% level instead of 2%. And both these things impact inflation, but the key is to get into what they call restrictive. And restrictive means it's less growth. But what we're seeing now is resiliency. And the Fed doesn't really know if they're restrictive yet. They believe they're restrictive, but it's the data that they look at to confirm that. So we've got these one-off prints in January, right? We had strong employment, strong retail sales, rebounding PCE. Those are just that one prints. So the data for March and April is extremely important because you get two strong prints, that's a tentative trend. And if you get three, that's a trend. So that's going to determine what our outlook for the terminal Fed funds rate is. The market right now is discounting the terminal is going to be 5.5, and they see that basically late summer. That will change depending on the numbers we get in March. If we get a confirmation of the numbers we got last month, that'll raise the expected terminal rate to 5.75. If we get that confirmation again in April, it'll raise it to 6. So people say 6%, could the economy handle that? I would actually reverse that argument. The reason why we're getting to 6% is because the economy is doing very well. And there's not a lot of slack in the economy. So that's an important thing to remember. And I believe that the Fed and the Bank of Canada will err to lower hikes rather than higher hikes, so 25 basis points instead of 50, because of that lag effect, and they don't know. So we see 6% as a possible terminal. But now we can move to 10-year bonds. The drivers of 10-year bond rates are different than the driver of just monetary policy. You can say monetary policy is inflation driven and what the central banks do. 10-year bond rate is definitely inflation driven. That's one component. The second component is what they call real rate driven, which is a reflection of growth actually. So part of the way you get lower growth is you increase the interest rate in 10-year bonds, so people rather invest in 10-year bonds than invest in the company. And then there's that risk that, the Fed may actually be behind the curve, so you need risk premium because there could be more inflation than expected going forward. So because of that, it's our sense that we tend to agree with the market in regards to pushing out the probability of a recession. and reducing the probability of a recession for 2023 because we believe the economy is more resilient. So there's a lot of credible paths here in regards to interest rates higher, interest rates lower. The one thing that will be for sure is increased uncertainty, increased volatility. So one of the key things to keep in mind is that it's not just about the destination now, rates higher, rates lower. It's about the path to that. Because similar to 2022, we'll see interest rates spike higher and then spike lower. And these are key things to remember in regards to the path dependency of interest rates. So just to conclude here, the two key words for fixed income this year is resiliency and volatility. We see Fed funds terminal rate at around 50 possibly up to 50 basis points higher than market, so between 5.50 and 6%. And we do believe that this 4% 10-year yield now is a very important yield. If we do break it, which it seems like we will, we could easily go to 4.25, 4.5 before rebounding again. And with that, I'll conclude for now.
Earl, I'm going to put you on the spot. You're now in Vegas. Okay, 100 basis points increase from today in interest rates. And you can pick 5-year, 10-year, 2-year. What are the chances it'd be more than 100 a year from now or less than 100? And you can tell me, I want you to, so because I'm going to hold you to this, so I want you to tell me what index you're taking.
Yeah, you know what? It's an interesting question because right now 10-year rates are at 4%, and 3 weeks ago they were at 3.30.
I know.
They've sold off by 70 basis points, so you would argue getting to 3% is probably easier getting to 5%. However, I do believe in the resiliency of the market, and that, and I won't go into the details now, but because of QE, the impact of the Fed hikes is being blunted. So I do believe that the economy could be very resilient and surprised to the upside this year, which means, you know what, I think we see the 5% level before we see the 3%. But there would be more people that would tell you 3% than 5%, but I'll take the other side.
All right. That's on the record. And not only will I remember it, but our next speaker will remember it as well. So thanks a lot, Earl. Now we're going to Brian, Chief Investment Strategist for BMO. Brian has been right in terms of the direction of the market since I think 2010, maybe 2009. And he's a long-term guy. He's always been optimistic on the markets. And I guess the first question to you, Brian, are you still optimistic?
Well, Dave.
And welcome. And welcome.
Oh my gosh, what an honor. I must say that you are my favorite U.S. bank CEO. Let me just say that. Thank you so much. Our call remains resolute, Dave. It's not that I'm stubborn. I believe it. And 8 out of 10 years historically, the stock market is positive. So we'll take those odds, number one. Number two, we still think the U.S. stock market is in the midst of a big 25-year secular bull market. And when you go back and look at history, you actually have seen several secular bull markets where you can have down years or you can have a flat year. And through this secular bull, Dave, that we think started in 2009, we've had flat years and we've had 3 negative years. So 2018, 2020, and 2022. And if you go back to the 1930s, there's only been 3 periods in the history of the markets, 3, where we've had consecutive negative years. 1938, 39, and 40, 1973 and 74, and 2000, 2001, and 2002. So what are the parallels, Dave? What are the parallels to those 3? Crisis. America was at crisis. First, we had the Depression going into World War II. Then we had the oil embargo, double dip recession. Then obviously we had the CapEx-led recession thanks to tech. And then, of course, the terrible occurrence of 9/11, which caused even deeper recession. I don't think we have a crisis right now. I don't. And yeah, I think you can either be bitter or you can be better. And so let's be better. And I think the U.S. stock market is amazingly resilient. You talked about in the beginning of the call, January was good, February was bad. It's been a little bit Charles Dickens, the best of times, worst of times. I think investors should get used to that. So what do I mean by that? So other people on the call are talking about their pedigree. I wrote my very first research report in 1989 when I was about 6 years old. And I've seen a lot in my career. I've been very blessed. I've been doing this for a long time. And one of my very first mentors on Wall Street used to tell me, there's always something going on. There's always something interesting going on. That hasn't changed. What I think has changed is the binary nature, Dave, of how people are trading their accounts and looking at investments, not long-term, more short-term, very reactionary, and looking at macro statistics. Again, no disrespect to the two prior speakers, but it's time for fundamentals to lead. And I still believe that the U.S. stock market is the best equity asset in the world, period. I live by this rule that stocks lead earnings, which lead the economy. I believe that there's so many people focused on trying to figure out the Fed and figure out the economy. I think it's really, really difficult. And when it's difficult, you default to quality. And so I really tend to want to be in more like value stocks, small mid-cap stocks, quality stocks, and growth at a reasonable price. The market environment we think that we're heading into for the next 3 to 5 years, no, we haven't used the term yet on this call yet, is normalizing. So in Earl's world, the average 10-year treasury since 1979 is 5.8%. The average 10-year treasury, if you don't include the financial crisis, is 7.6%. The average 10-year treasury since the financial crisis is 2.4%, Dave. If you've only been in the business since 2009 or 2010, what we have now is, of course, higher interest rates, but we're normalizing. So we can normalize interest rates. We're going to normalize valuations. We're going to normalize earnings growth to kind of single-digit earnings growth, high double-digit performance in the stock market. So kind of back to the 80s, a great decade of Packer teams. Not really. Not great Viking teams either. Better Minnesota Twins teams. But it was a period where fundamentals led, and we had different sector dynamics. From a sector perspective, Dave, we love financials in Canada and the United States. And we still believe that Canadian financials are the most excellent stewards of capital in the world. We do a great job in Canada and the Canadian banks with respect to paying dividends and buying back stock, but managing our businesses. In Canada, we also like the material sector. We love gold, and we love communication services in both areas. In the United States, we like more of the growthier areas like Netflix and Google within the communication services. But we think the communication services sector in the United States is the quintessential barbell, meaning growth and value in that sector. Lastly, we like healthcare. Healthcare had a great year last year. There's also a lot of great value dynamics within healthcare. And then I'd say lastly, don't abandon tech stocks. Don't abandon tech stocks. Just be much more selective. You don't have to own everything. Just be very selective and own kind of what we like to call the consumer staple-ish type tech that have great earnings, that are leaders in the marketplace, and that are important, not only dividend growers over time, but very strong earnings growers. So our year-end target is 4,300. That's our base case. Earnings are going to be down 5%. That's much less than what everybody else thinks. Given where cash flow is and operating performance of companies in the United States, we don't see the earnings recession like everyone's scaring everybody, because they're looking at the index level. And I'll leave you with this, Dave. Remember, the stock market is a market of stocks. Okay, so many people out there are so focused on what the S&P 500 is doing, or the Dow Jones Industrial Average. And like you said amazingly in the beginning, okay, you hear in the financial press about recessions or inflation. Every company is different. Every company is different. Every industry is different. Every sector is different. And that's why you have to really focus on the stock market is a market of stocks, default to value, and look for positive returns ahead. And with that, Mr. Casper, back to you.
Hey, thank you, Brian. And Thank you for that shameless plug on Canadian bank stocks. And we've got a lot of questions. People are asking, is he really only 38 years old when you wrote your first? So let me, before I turn it over to other questions, I hear a lot lately. You touched on it. The market has been pretty up and down, and you've got a call of 4,300. Is that what you said?
Yep.
But it could be 38, could be 35. You don't know. What do you say to people that say, "Hey, I can just wait this out and get almost 5% with a 2-year"? Brian, I know you're optimistic, but it's a 25-year bull. Why do I have to take my lumps? Why can't I just time this?
Well, no one can time the market. And that's why you have to be a long-term investor and have a great relationship manager. And I would say this, I think, one of the things that frustrates me the most is that we in the investment world love to pick on the stock market, but the bond market had a 40-year bull market and was very contemptuous and very frothy. And I think if Earl's right, and we're going to be at higher levels and then go down, then it actually probably should have a mixture of treasuries. And this whole notion of 60-40 becomes a lot more relevant, Dave, to have that with respect to a much more diversified portfolio. Again, we always think in the investment world of we're only stocks, we're only bonds. I think we're entering a period, quite frankly, much like the 80s and much like the early 90s, if you remember what happened in 94 and 95, where you could own both stocks and bonds together, and they actually, from a total return proposal, work very well together. So I think we're entering one of those periods again.
Great, thank you. We actually had over 100 questions that came in ahead of time. We've gotten through a number of them already. We're not going to be able to answer all of them, but I will try to consolidate. And I'll start with you, Scott. And this came a couple of different times. What do you really think the long-term effects are of this sustained inflation that we're in right now?
Yeah. Well, economists have been getting this wrong. Full disclosure, most economists thought it was transitory when this inflation broke out. Then we blamed it on supply chains and then the war in Ukraine. But I think there is a demand element to this, no doubt about it, with the Fed, more than doubling the size of their balance sheet, and the federal government continues to spend, trillions of dollars in COVID relief and other big spending packages, including the CHIPS Act and others. This might be around for a while. I mean, I'm old enough to remember the inflation we had in the 70s and early 80s, and it wasn't an easy animal to dispense with. So I think we have to be humble, and I think the Fed's got to be prepared that this might be a bigger battle, which means for investors, it means higher interest rates probably for longer, move to normalization or whatever you want to call it. But it's definitely away from the global stagnation scenario that macroeconomists and Larry Summers and others have been talking about for the last 20 years. This is really a different environment. And I think I've been telling our clients and customers that, this is unlike a recession we've seen in most of our working careers. I mean, you really have to go back to those recessions in the 80s or 70s to see a sort of scenario like this for the economy. It's not one of these slow job creation recoveries or sluggish downturns that we saw in the 90s or 2000s. All those were, financial bubbles, deflationary recessions. We're in a different sort of situation today.
Thanks, Scott. Earl, kind of along those lines, but a little different angle. When you look back over the last 18 months, what changes do you think the central banks what changes in their behavior might you see now going into the future based on the surprise we've had over the last 18 months?
Yeah, I think it's similar to what Scott said, actually. I think it's an acceptance of higher inflation, not 5, 6, 7%, but maybe 3 and 4. And in 2021, both central banks, Canada and the US, signed agreements with their government saying we have an inflation mandate for the next 5 years to get it to between 2 and 3. What I think is when those expire in called 2026, that inflation mandate is going to be higher. So I think what we're undergoing is a secular change. The central bankers realize it. It's going to be a 10, 20-year period of higher inflation, higher volatility, generally higher interest rates, and that will be reflected in the higher inflation target and acceptance of higher inflation, which is not necessarily a bad thing. And I think they would rather do it sooner, but they do have this mandate that they have to live up to.
Okay, thanks. Brian, I remember probably a little bit over a year ago, right when the war was breaking out in Ukraine, and you had a pretty good view at the time of what might happen, which I think has been generally right. But what do you think the impact on the markets is now going forward, and in terms of the war in Ukraine and the likelihood that it may last for a while longer?
Right, it's a great question. And when you're bullish in a down year, it's excessively humbling. And I think you have to be humbled sometimes in the market because the minute that you think you know everything, it's probably time to get out of this business. And I think everyone is so convinced now on the opposite side. And so I think there needs to be actually a little bit more humility on the bears, to be quite frank with you. But in terms of the timing of things, we were right in the direction. We just were wrong on the timing with respect to some of these things unwinding. And I think people digesting what's happening on a geopolitical front. I mean, think about last year from an equity perspective, how well European stocks did and emerging market stocks did last year, Dave, all in the midst of what was happening in Europe. Now, in Europe, obviously, Earl can speak to that if he wants with respect to what they're doing on the monetary policy side of things, but they're just beginning to really, on a relative basis, crank things up. So I think, obviously, there's always in this marketplace, there's always going to be geopolitical events. Now we have increasing tensions with China as well, and so you know what you can know. You have to control what you can control, and that's why, from an equity perspective, you have to have quality. Now, I will tell you, Dave, many of my more seasoned institutional clients that maybe have a little bit of this did not believe in the January rally and have been sitting on cash, and they're kind of waiting for this thing to flush out a little bit. And so I think that's also a sign of kind of being prudent and waiting. And there is going to be some volatility, but again, you just have to pick your spots and not try to time it.
Okay. Scott, we have had the supply chain issue has been with us for a long time, and the pendulum has probably shifted now. I don't know that in some cases the demand is still outpacing supply, but where do you see it going from here? And do we have the chance of maybe going the other way with demand really falling off and supply picking up? What's your sense there?
Yeah, well, we got some good news on the supply front today with China releasing their manufacturing PMIs, big jump, some of the best numbers they put out in more than a decade. So they're back up and running, right? Zero COVID's over there, and their factories are up and running. And we're seeing evidence of that in our data here in the US and Canada. Inventories are starting to rise. We've seen some replenishment of inventories. Supply delivery times are coming down. We got the ISM manufacturing this morning. There's other data too. You look at container prices from China to the West Coast, that's down 94%. The Fed's got a new global supply chain measure they put out every month. That's been continuing to come down for more than a year now. And it's not back to normal, but it's moving in the right direction. I still think there's a lot of uncertainty around, if there was a conflict that broke up, in the South China Sea, or the war in Ukraine worsens or broadens out, then there could be a reemergence of some of these issues. I do think we're going to continue to see supply issues in spotty markets in certain industries as we try to bring more production back to the US and friendshoring into places like Canada and Mexico and other Southeast Asian nations, as we try to move some production out of China to Vietnam, to India, and other locations. So that could raise costs. That could raise costs of production. A lot of big companies now know they need to have robust supply chains, probably more than one supplier in some cases. And so that's going to raise costs of doing business beyond just the labor market shortages that we've already talked about today.
So, before I go to the next question, Brian or Earl, you have anything to add to that?
I do not, no.
Brian, you're good? So Earl, you probably, and I'll be interested in anybody's view on this. We get a lot of noise about the debt ceiling and what might happen. What's your view on what impact that is or has already had or might have on rates?
There's a definite impact because right now what the Treasury is doing, they're using their cash hoards to pay off their bills instead of issuing more treasuries. So once the debt ceiling is solved, there will be a higher issuance of treasuries, which could put more pressure on that 10-year bond, which is another reason why I'm erring towards the side of higher yields. So I think that's an important thing. The other thing is if it's not solved, if they go to the 11th hour and go past the 11th hour, that is definitely leads to increased volatility and higher yields on the back end as well too.
Okay, thanks. Scott, we've got a lot of Canadians on the line who are asking about the Canadian housing market. I don't know if that's really for Scott or for Earl, but maybe both of you. And we, by the way, we got a number of questions on it on our earnings call yesterday. Who's got a view on that?
Yeah, I'll take a shot at it. Obviously, Canada's going through a lot of the same issues the U.S. housing market's been going through, but even maybe a little bit more on steroids because of the demographic and the increases we've seen in several key markets like in Toronto. So, the general view of the economics group and BMO is that, we'll continue to see home price declines this year and maybe another 5 to 10% decline in Canadian home prices this year from what we've already seen already. So, it's a sizable decline in home prices, but remember, we were up, 40, 50% home prices from where we were before the pandemic began. So, a lot of folks are still going to see, housing's still not going to be super affordable. And as mortgage rates continue to move higher, and we think they're going to be above 7% for some time this year, if the housing affordability issues are going to be continuing to be in place. So some of the stability we saw in housing stocks and home builder confidence January might be a little premature, and we could see some of those numbers moving back down as rates move.
Brian, I know you love North America, but one of our questions is, what about emerging markets, specifically India and China? How much would you invest there? What's your advice?
Well, a lot of the performance in emerging markets last year was due to the dollar, quite frankly. And so from a fundamental perspective, we still like the quality and stability of North America. I kind of go back to a story I've told a lot, that I was very blessed and fortunate to have the ability and very early in my career to meet both Peter Lynch and Warren Buffett. And they said to me both kind of the same thing: never buy anything unless you can reach out and touch it and understand it. And so we've got thousands and thousands of companies here in North America that we can buy. I don't think there's really any reason why you have to own things overseas unless you have this want and need to be diversified in those areas. There's a lot of great companies in Canada and the United States that kind of keep you away from maybe geopolitical risk in either India or China or the not. Remember too that this major theme of onshoring with a lot of companies coming back to North America is going to put pressure on some of these emerging markets areas as well. So why not stay home?
Why did I know you were going to say that? Okay, here's one that's going to hit very close to home, and this could be someone in the U.S. or Canada. The question is, if I can't read it, for those of you who have an imminent mortgage renewal, ours being in August 1st, what would be the recommendation regarding the type and term for the next renewal? Okay, you guys, now this actually is going to affect somebody's pocket. Earl,
I'll take a shot at this. I had to answer this for my brother-in-law. My brother-in-law asked me this question because he had a renewal.
It might have been him that asked it. And
So
if it was Earl, by the way, if it was Earl, he didn't like your answer. So he
I don't know. I didn't ask him what he did, so I stay in my happy world. But but what I said to him, I said, by actually locking in term, you could create a win-win scenario for yourself. So let's say you lock in a 3-year fixed term and rates go down. Yes, your mortgage would have been less, but if rates go down, your house price is going up. And let's do the opposite. Let's say you go in a variable term and rates go up. You're going to be out of luck there and out of luck on the pricing valuation of the house. So, you know, fixed income guy, I'm more conservative, obviously. I prefer the term and not taking the bet on the variable, and create a win-win scenario for myself versus the asset value of the house. That was what I told him.
Anyone else want to weigh in?
Yeah, I'd say lock in now. I don't think, 30-year mortgage rates are probably going to continue to move higher here, at least, for the next 6 to 12 months. So if you're in the market near term, sooner you lock in that rate, probably the better. We did see that nice drop in 30-year mortgage rates since November, and it has come up quite a bit already, but it could move even higher. 6 months or so.
I'm
Especially
gonna add one more thing. The curve is inverted, so actually locking in for term is less than your variable. So that's another thing to note. No.
Yeah. Good point.
Brian would say borrow as much as you possibly can and put the rest in the market. You guys have been great. I think our time is up. I can't thank you enough. I thank all of our clients and our employees and anyone else that's on this call for joining it. And we'll be watching carefully. This was taped, so we'll keep track of what you guys said. And it's been my pleasure to be with all of you. So thank you very much.
Thank you.